Hello and a warm welcome to Talking Stocks. I'm Gugulethu Cele, and with me in studio every week are Peter Armitage and Sean Ashton, both from Anchor Capital. Now, these two are the experts who'll give us their insightful analysis into the JSE listed companies. And this week we take a look at agriculture and agri-processing business, also known for all things sweet, is Tongaat Hulett. Now, the company produces a range of refined carbohydrate products from sugarcane and maize. The business's sugar operations span across the SADC region in areas such as Zimbabwe and elsewhere on the continent. Well, gentlemen, to get a picture on Tongaat, a lot of people know it as the product that they use for sugar, but there's a lot more to it than just being a sugar producer.
Absolutely. I think the bigger part of the business now is actually the property holdings that they have in the KZN North Coast. Certainly in terms of our estimate of where the value of the business sits. And you've seen that started to be reflected in the share price over the last 6 to 12 months or so. I think the performance is decoupled from what's happening in sugar dynamics.
Maybe if we can peel back the layers to this and actually show how we can unlock the value in the portfolio property of this company. Where does the land come in? Is this where they're producing the sugar, or are these used for land developments? Your perspective on it?
So historically, I think a lot of the land has been for sugar production, but given the growth of what's happening in the KZN North Coast, specifically as Durban is moving northwards, so a lot of that land which previously was under cane, or still is under cane, the values of it are rising substantially. In many instances, it's actually ocean-facing prime property. So what these guys are increasingly starting to do is to get outgrowers, farmers that are not employed by Tongaat Hulett to actually supply cane to their sugar mills. And as a result, they can free up that very, very high-value land to develop into commercial, residential, mixed-use developments. And we believe that a lot of value will be unlocked in that process over the next 5 to 10 years.
Looking at their strategy, it involves, as you mentioned, some urban developments at Mhlanga Ridge Town Centre and a couple of other places. Is this a defensive play to their strategy other than the agricultural initiatives?
No, I think it's just a case of the community's growing. If you know Natal North Coast is a developing fast right up the coast, and there's just tremendous value to be created. There's a lot of areas, something like Zimbabwe was a sugarcane field. So it's a case of realizing value. And I think an important thing to understand as well is the airport, the new King Shaka airport. There isn't a major airport around the world where over the course of 10, 20 years after its opening, that there isn't a huge amount of industrial development around the airport. And they own effectively that whole ring around the airport. So timing is uncertain, and that's one thing we can't predict with certainty. But what you can be certain of is over a 10 to 20 year period, they're going to sell that land and develop it at huge profits.
How sustainable is this for the long term?
I think the amount of land that they've got, it takes us 10 to 20, 30 years into the future.
Worth about 50 million?
Well, I mean, Sean
conservatively.
Conservatively?
Yes, I mean,
in today's money as well.
When we talk about how much land value there is, we're only really looking at the areas that they're targeting for development over the next 5 years. In reality, there's a long tail of hectarage that plays out well beyond that. Now, I think in the overall figures, there's something like 3,000 hectares that they're targeting for development over the next 5 years. If you conservatively assume just north of 3 million rands per hectare as a value, that's 15 billion rand, which is about 133 rands per share. Bearing in mind the share price is 150. So almost all of the share price is in the value of the land that they can unlock over a 5-year period. Now, of course, that goes up. You would expect that the value of that land rises, at least in nominal terms, over the next 5 years, and then you're still left with a large tranche of land outside of that hasn't yet been developed.
When we're talking about the land opportunity, or the portfolio property rather, we are certainly talking a good story here. But how much of that actually makes up a part of Tongaat?
Well, measured by valuation, we're saying it's 130, 140 rand out of value, but interestingly, the introduction to this program, we were talking about sugarcane and sugar production. And the business, from a profit point of view, it's dominated still by sugar, and that's Zimbabwe, some other African regions, and South Africa. So that's the kind of operating profit. But the property profit can be more lumpy. I mean, it's been increasing quite steadily over the last little while. But from an actual value point of view, you know, and that's what we find so interesting about the share, is the value sits more in the land than the operations.
Maybe let's talk about how you value the land proportion of the share. You mentioned that it's a 15 billion rand portfolio, 133 rand a piece for the share. The land, how that comes into that
there's
calculation?
a couple of ways of looking at it, and it's obviously a complex issue that people have to get around. And incidentally, I think this last year was the first year where property profits were actually more than the sugar and starch individually. Sugar and starch together still made up more, but property was the single largest driver of profits, made about R1 billion last year. But I think obviously that's going to be a lumpy earning stream because it depends on when you sign a deal to sell off a chunk of land. The timing of booking those profits will be very, very unpredictable. But another way of looking is to say this tranche of land, and it depends on which piece of area you're looking at, will attract a certain amount of value per square meter or per hectare. That's the approach that we've had in valuing that land. Is to say, if you look at the Mhlanga Ridge side, we're expecting them to, there's a 42 hectare parcel of land that they're likely to sell off in the next 6 to 12 months. We think it could come in the second half of this year. They've already achieved values of 35 million rands per hectare in that area, in that specific area. And that compares to, remember back to the original number I spoke of, 3 million across, 3 million rand a hectare across the whole portfolio. So it's 10 times that. That's obviously a very high value parcel of land, but there's a benchmark now. So you know that they've achieved those values in that area. And there's another 42 hectares of land that they'll likely sell off. Now that could be 1.5 billion rands worth of property profits, just that one parcel, which could come through in the second half of this year. Clearly that's not a sustainable run rate. But what we're saying is, if you look at the value of the land in aggregate, take the developable hectares that will likely be monetized over a 5-year period and conservatively apply a number which you think is appropriate. And we think roughly 3 million rands per hectare across the whole portfolio is fair.
I'm in awe here because this is a sugar company that we so often refer to as a sugar company. So it does seem as though a lot of the opportunity is locked up in the land and the progress that can be made there. But if we do take a look at the soft commodity, which is sugar, the prices have been under significant pressure recently, as with all commodities. The import tariffs that we've seen being put in place, do you think that might have had any implementation or any benefit rather to the company and its numbers?
Yeah, there's 3 key things that you've got to take into account. And Tongaat is an extremely complex company to try and get a hold on. Number one is the global sugar price. Secondly is the rand-dollar exchange rate, because obviously what we're seeing is the results in the selling price in rands. So if you've got a weakening rand, that's quite positive from that perspective. And thirdly is the regulatory environment. So they've got quotas at certain prices into European countries. There's regulated local prices. There's import tariffs coming in. So it's a mixture of these things and it's always quite difficult. You know, we've looked at this company for 15 years to try and predict the average realization, the sugar price that they're going to sell for. But ultimately, if the global sugar price is low, that can't be good for the next 3 to 5 years. And that's been one of the things putting a bit of pressure on the Tongaat price. So you've seen the price do extremely well. I mean, at Anchor Capital, we got into it.
The low 130s.
Yeah, just also, we started off when we first started our business at 80 rand and again at 130. But the sugar prices weighed a little on it. But the point that we're making is it's the actual the land value outweighs that in the short term. Although the sugar and in fact the last results, the weakest sugar profits were more about production issues than price. But the pricing equation for the next 2 or 3 years isn't a terribly positive one. But we think the overall profits of the business can more than compensate for that.
I also don't think it's just about price. I mean, the other angle is cost. I think the key thing to understand about Tongaat, or specifically sugar production and the business of making sugar, is it's quite a high fixed cost business. So when you look at what they're producing, they have capacity for north of 2 million tons worth of annualized production in terms of sugar. They're producing, I think, now 1.3 million tons. And Zimbabwe and Mozambique have been ramping up quite substantially in recent years. The reason why South Africa has been down has largely been a weather issue, where you haven't had enough rainfall in the KZN area. So that could be deemed to be a transitory issue. But what the company is guiding to is to move sugar production from 1.3 million tons to 1.8 million tons over the next 4 or 5 years. So that's kind of 8% per annum. And at the same time, there's an element of costs which are relatively fixed with respect to that production number. So your unit costs of production should fall, and as a result, margins should rise. So I would estimate that unless the sugar price really collapses quite heavily, you'll probably see steady sugar production or trend rates of sugar profits of more than 8% per annum, would be my guess.
Well, let's certainly hope so, that the commodity prices don't take a significant hit. But let's see the view of Tongaat Hulett Chief Executive Peter Stader and what he had to say about the company's improvement in its profit following its most recent results, and how this might have helped the company move forward, as well as manage to publish such solid numbers following the business protection measures that have been put in place, like the import tariffs. Let's take a look.
We dramatically reduced costs in all three of the countries that we operated in. It was a little bit masked last year because we had a negative cane valuation. We were able to consolidate those cost reductions at the same time, not have those cane valuations negatives this year, so you saw an improvement in profit as a result of it. Obviously, from a protection point of view, one has to put always that protection in context. This is essentially an industry where people don't produce more, produce less. Typically in a 10-year cycle of sugar production, and you have periods when you had great weather conditions worldwide, where there are a couple of surplus producers. They tend to send the sugar into deficit countries, but really is a poor outcome when they send that sugar also into surplus producing countries, and that has been essentially the conversation about protection. During this last period in Zimbabwe, we've been quite successful in that protection. In South Africa, you still had a bit of an overflow of the previous year's imports.
Well, he did mention significant cost reductions there. Is that something that they can carry on with going forward?
Well, I think that's part of the equation that Sean's talking about, where you've got increased volumes on top of a fixed cost base. So, he's talking about cost per ton as opposed to overall cost. I think the other interesting thing to note with Tongaat is people perceive it as a South African sugar company. In fact, the Zimbabwean operations and the Mozambique and other are more significant than South Africa. And it's much more productive to grow sugar in those countries. The soil and the rainfall and the like results in much higher yield than comes through from South Africa. So South Africa is actually about getting other farmers to chuck stuff into their mills and create value like that. But they've had massive expansion in Zimbabwe, which of course also has its issues.
Indigenization, which is another regulatory aspect to it. But nonetheless, it is a Pan-African player. It has a strong property contingent, and it makes all things sweet. But time now to get our experts' view on this particular stock. Buy, hold, sell.
Property, as we've mentioned, is a big underpin to the share price and probably going to be a growing contributor to profits. That's 133 rands worth of value, to be not too precise. Let's call it 130 rands worth of value. And by the time you've added in sugar and starch at reasonable valuations, we don't think they're high PE businesses. If you apply 10 times profits to 10 times earnings as a multiple to those businesses, and you subtract the debt out of the equation, you're sitting with a share price that you could ultimately justify 200 rand. So, or certainly very close to. So I would rate it a buy.
So almost buying in the dips. Peter and Sean, good to have your insights with us today. Unfortunately, that's where we have to leave it. But do join us again next time, where we do all of this again and unpack a particular stock listed on the JSE. But from everyone and myself here at the team, it's goodbye for now.